Good morning, ladies and gentlemen, and welcome to the Epoch Investment Partners webinar this morning. My name is Stephen Fletcher, and on behalf of all of us at GSFM and Epoch, thank you very much for taking the time to join us this morning. If I could, I'd just like to take this opportunity just to introduce a new team member at GSFM on the distribution side. Josh Nissenbaum is joining us fairly recently, and he actually joined us back in September, and he's joining the team in Sydney. And he's working alongside Steve Higgins, and together they will look after your needs in New South Wales and also the ACT. So no doubt those of you in New South Wales will meet Josh at some stage, hopefully in the near future. So joining us from Epoch in New York today, we have John Tobin. So good evening, John, and welcome.
Hi, Steve. Good morning to you.
It's great to have you on the call, and thanks again for joining us. For those of you who don't know John, John is a managing director, portfolio manager, and also a senior research analyst at Epoch, and is part of the Shareholder Yield team. Prior to joining Epoch in 2012, John was an economics lecturer at Fordham University, where he also earned his PhD in economics. Before that, he worked at HSBC as a senior research analyst, and almost 20 years at Credit Suisse Asset Management, where he was a senior research analyst for the US high yield bond team. And John is also a CFA. So the session today will run for approximately 30 minutes, and we'll then take your questions afterwards, which you can enter at any time at the bottom of your screen in the Q&A box. But just as a brief introduction, as most of you would know, the key objective of the Epoch Fund is to deliver consistent income from a growing stream of dividends, which pleasingly it has successfully delivered now since the Epoch Funds were launched in Australia back in 2008. If we take our minds back, it was a very different market environment back then compared to what we have today. In 2008, investors were able to secure a term deposit paying roughly 8% per annum. Now, since then, as we all know, central banks have pushed down bond yields, making it really difficult for retirees and diminishing what was once the cornerstone of income generation. So with retirees effectively being forced up the risk curve to generate more income, John will talk today about some of the advantages of investing for dividends from global equities. He will also provide an update on the Epoch Fund and discuss recent performance, positioning, and also share with you Epoch's capital markets outlook. So with that brief introduction, John, I'll hand over to you. Thank you.
Thank you, Steve. I appreciate that. And thank you, everyone, for joining and giving me some of your time this morning. As Steve said, I've got about a 30-minute presentation for you, and then hopefully we'll have some time to entertain questions. The first slide that I'd like to share with you, Steve, if we could advance to the next one. What I'd like to begin with, if we could, is a quick review of the objectives and the methodology of the shareholder yield strategy. And so on this slide, we've got them laid out for you, the methodology. What is it that we do? Well, we seek to build a diversified portfolio, a global equity portfolio. We're looking for high quality companies that are generating significant and growing cash flow. We focus on companies that have demonstrated sound capital allocation practices and policies, in particular with an emphasis on paying dividends and using excess cash flow to buy back stock or to reduce debt. We seek deliberately and consciously to diversify the sources of return across companies, across sectors, and across regions in order to improve the likelihood of achieving the objectives of the strategy. So what are the objectives? Well, first, we want to deliver returns that are at least in line with the market over time, but with lower than market volatility. We want to provide consistent income, as Steve said earlier, from a growing stream of dividends. It's a strategy that also seeks to offer defensive characteristics along with upside participation. And it also, because of the nature of the strategy, it's different and therefore offers low correlation with other investing strategies. In the long run, it's our belief that dividend yield and earnings growth are the primary drivers of stock returns. And if we take a look at the next slide, if you've been involved with Epoch, if you've been involved with the shareholder yield strategy, you have seen this slide before. And I know it's a messy and complicated graph, but I want to use it in the introductory part of my talk today because it really is, the word that I use to describe this is it's foundational. It's foundational in terms of epochs, guiding philosophy around investment. We're looking for companies and we're focused on cash flow. So what does this busy slide have to say? Well, what we're doing here is we're looking at the Standard & Poor's 500 index. So this is meant as an illustration. We've looked at that index going all the way back to 1936. So a very, very long history. And we've taken the total return for the Standard & Poor's index, and we've broken it down into three component parts. How much of the return is due to changes in price earnings multiples? How much of the return is due to earnings growth? And how much is due to dividends? And the takeaway is that over periods of time, it is certainly true. We know this, we've seen this, we've all experienced it. Price earnings multiples can be the driver of return in any period of time. But the longer your time frame, the more you stand back and look at the long history of investing in global equity markets, the more it becomes apparent that these PE multiples, the positive and negative effect of multiple expansion and contraction, it fades over time. Indeed, it washes out over time. And what you're left with is earnings growth and dividends as the fundamental drivers of long-term equity returns. If you can focus on that long-term history bar chart there towards the right, you can see that on average, the return for the Standard & Poor's 500 index has been just about 10% per year, of which 3.8% is due to dividends, 4.9% is due to earnings, and only 1.4% is due to multiple expansion or contraction. So those are the three key takeaways from this graph, and I'm going to come back to it as I wrap up at the end. So now, if you would, let's take a look at this next slide. I wanted to take a look back at 2020. 2020 was an unusual year, to be sure. It was a challenging time. It was especially challenging for investors in a strategy like shareholder yield. If you're involved in dividends, if you're involved in income, if you have a value tilt, there were significant headwinds for those kinds of strategies. The market was very focused on momentum and growth. And as we look at 2020, we found this way of breaking it up very, very helpful. So to us, the story is, what's the story? The story to tell about 2020 is it was a tale of two periods. The chart on your left, which is from March 23rd, 2020 until August 31st of 2020. Now, why March 23rd? Well, March 23rd was the trough in the market. And you could pretty much look at just about any equity market index. That was the bottom of the first quarter pandemic drawdown. And when the market turned, it turned dramatically. And you can point to that date and say that's exactly when it turned. So if you look at the roughly 5-month period from March 23rd through the end of August of 2020, this depicts what happened. You see the performance, the total return for the Global Equity Shareholder Yield Fund, for the MSCI World Index, and for the MSCI World High Dividend Index. And pause for a minute and look at those numbers. What that says is that in that roughly 5-month period, the MSCI World Index in US dollar terms rose 55%. That's extraordinary. The Global Equity Shareholder Yield strategy also enjoyed a very nice recovery from that first quarter drawdown, but we were only up 41%. So there's almost a 14 percentage point gap between the Global Equity Shareholder Yield strategy and the main benchmark index for the strategy, the MSCI World. And it's just dramatic and it's extraordinary what happened in the markets in that period. If you look at the right-hand side of that chart on the left, that gray bar, that's the MSCI World High Dividend Index. And what I think you can see in that comparison is that while the shareholder yield strategy lagged behind the MSCI World Index in that initial snapback recovery, we did what other dividend strategies were doing, maybe even a little bit better. So relative to our peers in the dividend world, in the income investing world, we were doing relatively well. It was only relative to the broader market that we were lagging. Turn your attention to the right-hand side of this slide, and we're looking at the period from August 31st through December 31st, the last half of the year, roughly. And there you can see shareholder yield and the MSCI World Index and the MSCI World High Dividend Index all together, sort of running neck and neck. Well, what was the difference? The difference was, first we had growing optimism about vaccines being rolled out. And then of course, in November of 2020, we got the news from Pfizer and from Moderna about their vaccines. And that ignited a rally. It opened up the reopening trade, the reflation trade. And what it meant was that the leadership of the market was no longer so narrowly defined. In that earlier period, in that snapback period, it was a very narrowly defined market with leadership concentrated in tech and e-commerce names. And in the latter half of the year, after August 31st, it was a much more competitive horse race. So let's take another way of looking at that in the next slide, just to see how narrow market leadership was in 2020. This slide that we've called the Fab Four, it's another example of how extraordinary the environment was for investors in 2020. We're looking at four stocks: Apple, Microsoft, Amazon, and Tesla. The top half of the page shows you year by year the weights of those stocks in the MSCI World Index. Together, all four of them together in 2016 represented 4.2% of the index. And you can see how they were growing in relative importance. 5% of the index in 2017, 6% of the index in 2018, a little over 7% in 2019. By the end of 2020, those four stocks were 11.3% of the index. There was a step change in 2020. The bottom half of this slide looks at the contribution to return for those same four stocks and over the same time period, 2016 through 2020. If you look at 2016, for example, those four stocks together generated a return of 0.5%. Their contribution to return, the multiplication of their return and their weight in the index is the arithmetic for calculating contribution to return. And the MSCI World Index that year was up 7.5%. So those four stocks accounted for a little over 6% of the return in 2016. Fast forward to 2020, those four stocks accounted for 46% of the return that was generated by the index, the MSCI World Index in 2020. This is an index that has 1,500 stocks. And in 2020, those four accounted for almost half the return that was generated. So really and truly an unusual and extraordinary period of time. But it did, as we alluded to earlier, and I've got the next chart to maybe demonstrate how there did occur a change, and it occurred in the fall, in November. So what is this slide here showing? This one, which we've called the big catch-up, shows how the environment changed. And you've got two time series here. One is for the MSCI World Index, and the other one is for the NASDAQ 100 Index. And we're looking at the percentage of stocks in each of those indexes trading above their 250-day moving average level. So going from left to right, on the left-hand side, you see there's a big gap. The blue line, the NASDAQ index, is pretty far above the brown line, which is the MSCI World. If you look at, say, June of 2020, the way to interpret this is, in June of 2020, about 40% of the MSCI World stocks were trading above their 250-day moving average, while about 70% of the NASDAQ stocks were trading above their 250-day moving average. So again, this snapback rally after the initial drawdown and in the first quarter of 2020 was led by those mega cap tech and e-commerce stocks. And the rest of the world, in effect, was left behind. As your eye moves from left to right in this chart, around October, November, you see the big catch up. And what we're pointing to there is, as soon as we got news in November about the successful vaccines, that was a game changer. And we saw that brown line, the percentage of stocks in the MSCI World Index trading above their 250-day moving average, move up dramatically closer to the NASDAQ. And what you see in this graph as you go forward from left to right, for the remainder of 2020 and in fact throughout the entirety of 2021 so far, these two lines are trading right on top of each other, which is to say that the experience of how many stocks in each of these indexes is trading above a 250-day moving average, they're behaving very similarly. So that's what we've referred to as the great catch-up. That change, as I said, took place around the end of the third quarter, beginning of the fourth quarter of 2020. And the environment for a year now has been a much more stable, a much more normal, if you would, environment. And if we flip to the next slide, what I'd like to show you here is with this return to a more normal market environment, at least in terms of market leadership and market breadth, the shareholder yield performance relative to these benchmark indices is as we expect. It's performing as we would expect in the current market environment, as we expect and we think as investors should expect us to as well. So the left-hand side shows year-to-date 2021, December 31st, 20 through the end of September of 2021. Shareholder yield strategy is up about 18.1% in Australian dollars. The MSCI World X Australia Index is up 21%. And the MSCI High Dividend Index is up 15.6%. So we are lagging behind, which is what you'd expect in a market that is moving ahead dramatically the way the market is today. But the gap between us and the MSCI World is relatively small, and it's in line with historical experience. We say that as I said on one of the first slides, one of our objectives is to provide good upside participation. Well, in this period of time, we're giving about 87% of the upside in this market environment. So in our view, managing the strategy, this is what we would expect to see. We are happy to see this. This is good performance for the shareholder yield strategy. And relative to the MSCI High Dividend Index, we're a little ahead of that year-to-date period. On the right, you see the 12-month period, September 2020 through September 2021, very similar pattern. The shareholder yield strategy is up 22.5%. The MSCI World Index is up 27.8%. And the high dividend index just under 20%. So again, we're lagging behind a little bit the MSCI World as it rallies. That's a pretty impressive total return for a 12-month period, almost 28%. So we're getting good upside participation, and we're also, again, ahead of the high dividend index. So we're doing what other dividend-oriented investors are doing, and maybe a little bit better than they are. So let's turn the slide to the next slide, if you would, Steve. So as Steve said, and as I alluded to, or as I mentioned at the beginning, one of the things that we try to do with this strategy is we're trying to invest in companies that have growing cash flows that allow for growing dividends over time. And over the years, we've seen that play out. This chart goes back to 2008, and it shows the number of stocks in the portfolio each year that have raised their dividends. And the portfolio usually has 100 stocks, give or take. I think we have 106 today. But that gives you a way of framing what does it mean for there to be 60 or 70 or 80 stocks raising their dividends in the portfolio every year. 2/3 to 3/4 typically raising their dividends. I'd like to draw your attention to the lower left-hand circle, the 2020 circle. 67 companies increased their dividends in 2020. The reason I want to draw your attention to that is because, of course, 2020 with the pandemic, the recession that the pandemic caused, the lockdowns that took place around the world, the economic impact of that, it led to lots of commentators making negative observations and forecasts. There was a lot of angst around, would companies be able to maintain dividends? Would they be able to maintain their share buybacks? And perhaps they would just go into a long retreat. Well, in fact, as this chart shows, 67 companies in the portfolio, the shareholder yield portfolio, raised their dividend in 2020. Now, to us, we feel somewhat vindicated by this. As I said, back in 2020, in the depths of the pandemic, lots of commentators were talking about how dire the outlook was for dividends and dividend-paying companies. We did a webinar, which maybe some of you saw and participated in April of 2020, and we called it the death of dividends, greatly exaggerated. And we made the case that while many companies in this kind of environment would have to adjust their shareholder distributions, it would still be true that many companies would be able to maintain their dividends, would be able to grow their dividends. And indeed, that's what we saw. The argument we made at the time was that companies would not abandon sound capital allocation practices and policies as a result of the dividend. And what we have seen since the fall of 2020, throughout all of this year to date, we've seen companies raising dividends, and we've seen companies resuming share buybacks. So as we expected, and we're very happy to see that this has played out that way, as we expected, companies, once their businesses started to recover, they would return to those capital allocation practices, including paying attractive growing dividends and using excess cash flow to buy back stock and pay down debt. The next slide is also a familiar slide. If you've been following shareholder yield, this looks at the yield for the portfolio, the yield generated by dividends on a global equity portfolio relative to the yield available from an investment grade bond index. And the shareholder yield strategy continues to offer a very attractive and compelling source of income from a diversified portfolio of high quality companies paying attractive, growing dividends. And the next slide, finally, just to sort of as a proof statement, we seek to provide upside participation with downside protection, and the evidence continues to be compelling that the shareholder yield strategy offers good downside protection. In times when the market was negative, the portfolio outperforms 72% of the time by an average of 3.85%. And when the market is down significantly by at least 5%, in those episodes, the strategy has demonstrated that it outperforms 82% of the time by an average of a little over 5%. It's certainly not the case that I can say to you, pick a day, any day, if the market's down, we will outperform the market on that day. Markets are volatile, there's random noise, and every day is a little bit different, and sometimes every day is a little bit of a mystery. But over time, what we see is a nice, consistent behavior of the strategy in down cycles. And it's very helpful for investors to protect wealth. So I got another slide to share with you, and this is one where, as we contemplate the outlook for global equity shareholder yield, as we start to talk to investors about what does the future look like and what could we expect from shareholder yield in the environment that we foresee, we have to ask the question, how much more can tech stock multiples expand? What I'm showing you here on this chart is data for the NASDAQ 100 index. So these are primarily the mega cap tech and e-commerce stocks. And you've got 10 years of history there, both for the price earnings ratio and for the enterprise value to EBITDA ratio. So two generally accepted measures of multiple. And you can see that over the period of 10 years, there's a pretty significant and dramatic increase in both of those multiples, a big expansion of multiples starting at about the end of 2019 and going into 2020. So there's the question, how much more can stock multiples expand? To answer that question, I go back to the slide that I showed you at the beginning, the one that I referred to as our foundational slide, the one that shows that over time, stock returns are driven by dividends and earnings growth, and the impact of multiple expansion and contraction fades and washes out over time. Long-term equity returns are driven by earnings and dividends. And the question I think that's left hanging in this picture, in this graph is, well, how much more can tech stock multiples expand? And another way of phrasing it is, what's the risk in my portfolio if I'm overexposed to those stocks that have seen such dramatic multiple expansion over the past year or two? So let's specifically looking ahead at global equity shareholder yield in the next slide. What's the near-term market outlook that we see? Well, we see global economies continuing to reopen. Granted, this is happening unevenly. It's not a smooth, straight line. Unevenly due to varying vaccination rates, varying availability of vaccines, variable acceptance of vaccines, and then, of course, the experience most recently with the Delta variant of COVID-19, which did cause a spike in cases. And in the United States, we certainly saw a spike in hospitalizations as well. But nevertheless, the underlying pattern that we see is economies are growing. There's an awful lot that's being written about today, a lot of commentary about growth slowing and perhaps past peak growth in this cycle. I would put on my economist hat and point out to you that even as growth rates are slowing around the world, these are economic growth rates that are well above trend. If the United States economy slows down next year and grows at a GDP rate of over 4% or even 3.5%, that is significantly above the long-term trend growth of the US economy, which is maybe 2.5% per year. And the same thing is true for the global economy. So I think it's important to keep perspective on what we're talking about when we talk about slowing growth. We're talking about growth decelerating. We're talking about growth rates that are returning over time to trend growth rates. That's the way we would phrase or frame the general GDP and economic growth outlook. Of course, monetary and fiscal policies remain very supportive. And again, lots of headlines these days about central bank policies, about them becoming less accommodative. There's certainly talk in the United States about the Fed potentially starting to taper the quantitative easing program as soon as next month. Keep in mind that even as this starts to happen, what we're talking about is central banks slowing the pace at which they are actively buying bonds by the many, many billions in the marketplace. That process is likely to continue in the United States until at least the midpoint of 2022. Other central banks similarly will be moving very gradually and very cautiously to reduce accommodation. Interest rates from the central banks are probably not going to start rising until the latter part of 2022. And when they do, we expect that also to be done in a cautious and gradual pace. So yes, monetary and fiscal policies may be becoming somewhat less accommodative, but they nevertheless are in what we would describe as an economist, an accommodative stance. They're supportive. What about inflation pressures? Well, I think inflation pressures are a concern. We all read about the supply chain issues that are causing spikes in commodity prices, freight prices, transportation costs. We're seeing it in labor costs. It's quite likely that some of these transitory inflation pressures, some of them are probably not going to be transitory. Some of them are going to be with us for a little while. Transitory is a slippery word. And if you thought transitory meant 3 to 6 months, that's probably not what transitory really means. And that then leads to an environment where it is likely that interest rates are going modestly higher, not lower. We see the dance, if you will, day to day with the 10-year US Treasury, if that's the benchmark that the world wants to look at, a little bit higher, a little bit lower. It's over 1.6 today. That makes sense to us in a global economy that's expanding and recovering, where there are some inflationary pressures. It makes sense that the general trajectory of interest rates should be gradually and modestly higher. Well, this gets back to my last chart about multiples. Even a modestly higher interest rate environment creates a headwind for what we today are referring to as the long duration equities. Those companies where the cash flows, to the extent that they can be foreseen, are going to occur years into the future. So here's, sorry for the arithmetic here, but this is just the standard calculation of present value of a future stream of cash flows. And the interest rate, the discount rate appears in the denominator, of course. So as that denominator goes up, as that interest rate goes up, it pushes down the present value. And the more those cash flows are back end loaded in distant years with few cash flows in the early years, the more dramatic the impact on present value of a given increase in interest rates. Companies, the flip side of that is companies that are generating earnings and cash flows today and paying attractive growing dividends today, that same interest rate increase will have a more muted effect on present value, and indeed potentially the growth in cash flows and the presence of growing cash flows can even offset the negative headwind of a higher discount rate in the denominator. So my final slide, and then we'll open it up for questions for you. As we look ahead, we think that this brightening economic outlook is a good thing. It's a positive for earnings and cash flows. Companies around the world are continuing to raise dividends and resuming their share repurchase programs. And this is being done in response to business performance. Their businesses are doing better. We're going through earnings season right now. We're seeing companies report stronger earnings, stronger revenues, stronger cash flows, raising dividends, and engaging in share repurchase programs. We also see a market that is more broadly driven rather than one that's narrowly focused on a small handful of tech stocks. So broad participation across sectors, across industries, and across geographies, and we think that is a much healthier environment. And we think that in this environment, the global equity shareholder yield strategy should be able to deliver good absolute and relative returns, consistent and attractive dividend income, lower than market volatility, upside participation coupled with downside protection. That's the value proposition for the shareholder yield strategy. And finally, we believe that stocks that provide meaningful distributions to shareholders today should be more resilient than these long duration stocks in the face of potential pressure on valuations as interest rates tend to move higher. So I will stop there. That's just about 35 minutes. And that leaves us, I hope, enough time to entertain your questions. I'll do my best to answer them as best I can. Steve?
Yeah, terrific. Thanks very much, John. Thanks for that great update. That's much appreciated. So we do have a couple of questions coming through, and I might sort of just go back to these sort of help answers or help look at the near-term macro outlook that you mentioned. So the first one is around what we saw in September from the US Fed, and as you said, there was a signal back then that the Fed would potentially tighten monetary conditions sooner rather than later, which obviously sent yields higher and signaling a return of volatility to equity markets. If in fact the world is heading this way, can you relate this back to the shareholder yield strategy? So can you comment on what this market environment would look like for a yield-based strategy like Epoch?
Yeah, and I've alluded to it already, and I think the short answer is we're happy to see this. It is a good environment for us. Um, the idea that the Fed is going to be lifting rates above zero, that interest rates might be moving a little bit higher. You know what, Steve? One of the things that's interesting and maybe even a little ironic in a way, in the past, over the 15-year history of the shareholder yield strategy, one of the questions we would sometimes be asked is, well, you know, in a rising interest rate environment, isn't that a headwind for you because you know you own all these bond proxies? And we would always say, in response to that, that you know it's a little bit unfair to describe the stocks that we own as bond proxies because we've deliberately sought out companies that have attractive growing dividends. So even in that setting, we would say we've got companies that are growing, companies experiencing revenues, earnings, and cash flow growth, which allows them to grow their dividends. And so please don't think of them as bond proxies. So they should be able to do reasonably well, even in a rising interest rate environment. But what's different, if you will, about this current environment is there's been so much emphasis and focus in recent years in momentum and growth investing with this narrow market that's been focused on the FANG stocks and the mega cap tech and e-commerce stocks. What people are beginning to focus on, and I just kind of walk through the arithmetic around it, is these are companies for whom the revenues, earnings, and cash flows are years away. Netflix just reported the results after the close of trading today. And the big news from Netflix is that they think that they could be cash flow positive next year, which is important to be sure. But it's just, to me, an example of so many of these companies that have been the darlings for investors, and they've done quite well. And not to say that Netflix hasn't done well at all. It's done quite well. But when you look at the cash flows from this business, it takes years for them to reach a point where they actually generate positive cash flow. And in a rising interest rate environment, that's a headwind for these businesses. So I guess the short answer is we're happy to see the Fed moving in this direction. We're happy to see other central banks moving in this direction. It's a sign of a healthier economic environment globally, with more rapid economic growth, with a return to normalcy, with unemployment rates coming down. All of that is helpful for our strategy. It's a healthy backdrop, and we think it'll be a positive going forward rather than a headwind for us.
Okay, great, thank you. Another question here. An important part of your investment philosophy and approach is scrutinising company management's track record of allocating capital. Have there been any noticeable changes, positive or negative, to capital allocation policies across particular industry sectors, geography, that have led to changes in portfolio positioning? Sure.
So I would say the thing that comes to mind in terms of changes in capital allocation practices was what we saw in 2020. In my slide, I highlighted the fact that we had 67 companies in our portfolio raise their dividends, but let's be honest, it was an environment where many companies were in fact so severely affected by the COVID pandemic and the economic consequences of the pandemic that they canceled their dividends, or they stopped growing their dividends, or regulators told them to stop growing your dividends or to cancel your dividends, or to stop doing share buybacks. So that took place last year. And as we said with our Death of Dividends webinar, we thought once the world starts growing again, we'll see a resumption of these capital allocation practices, and we have. So I guess one way to answer your question is those are some changes that we've seen of late in terms of capital allocation. Now, I'd also perhaps point to some other trends that we see, longer term, more structural trends that are in favor of these types of capital allocation practices. We said for many years, as we looked at our global opportunity set, we didn't own any Japanese companies for a long time, and the reason was we didn't see the kinds of capital allocation practices being utilized to a large extent in the Japanese market. And what we've seen in recent years is an embrace of what we would describe as sound capital allocation practices. We've seen Japanese companies raising their dividends in connection with growing earnings. We've seen Japanese companies less inclined to hoard cash and build enormous cash balances on their balance sheets. We've seen them start to focus on identifying the businesses that are their core business and divesting non-core businesses. So all of these better capital allocation practices to us have opened up that marketplace as an opportunity for us. And today we have 3 Japanese companies in our portfolio today. So I think that this is a longer-term structural trend. We see more and more companies thinking about capital allocation in the appropriate way, which is to say, if you can invest and earn a return above your cost of capital, you should. And once you've exhausted those opportunities, you should give the capital back to the stockholders through dividends, share buybacks, and debt reduction. In terms of share buybacks, we're seeing in recent years a greater acceptance of the share buyback avenue as a way of returning capital to stockholders among some European companies who traditionally didn't embrace share buybacks the way US companies did. So favorable developments, which means that our opportunity set continues to be rich, and we continue to have a good set of companies to look at and evaluate and consider for inclusion in the strategy.
Terrific. Thanks, John. And just while we're on that topic, I mean, just in terms of the outlook for company buybacks right now?
Positive, indeed. I think there's almost a catch-up in a way that's taking place. That some companies that put their share buyback programs on hold in 2020 while they waited to see how things would evolve, are now sufficiently comfortable with their business outlook and the economic outlook that they have resumed share buybacks. And in many cases, we're seeing companies with sizable share repurchase programs underway, and indeed maybe even above average or above normal for them as they do a little bit of a catch-up. Certainly true with some of the financial services companies like the banks in the United States, for example, that were told by the regulator, by the Fed, no more share buybacks until we say so. Well, they've given the green light, and the banks have built up significant cushions of excess capital and are anxious to work the capital back down to where they would like it to be within the confines of what the regulatory requirements are. So we're seeing a lot of share buyback activity right now. And of course, from our perspective, we want to see share buybacks as a way of deploying excess capital. If you're a business and you've got some good opportunities to deploy that capital, you should be doing that with the capital rather than buying back stock. So we try to be discerning in how we evaluate companies and their allocation decisions. Not all share buybacks are the kind of share buyback that we're looking for in the shareholder yield strategy.
Okay. Another question that's just come through, John, is do you think companies will begin to reduce debt if interest rates begin to rise?
That's an interesting question. I think companies have certainly taken advantage of the low interest rate environment to recalibrate their debt on their balance sheets. I think any chief financial officer that didn't take advantage of low interest rates to reduce the cost of debt and extend maturities wasn't doing their job. And so I think many companies today would, if you're a chief financial officer, you might look at your balance sheet and say, I'm comfortable with the leverage that we have, and I'm really comfortable with our weighted average cost of debt that we've managed to lock in for many years. So I think maybe it's going to be very company by company, the way to answer that question, but I think there'll probably be lots of companies for whom their leverage is where they want it to be, and their cost of debt is very attractive. And I don't think that they would or even should be paying down debt that's very, very low coupon debt. I think it's kind of for some of these businesses, these will be sort of historic lows for the cost of debt on their balance sheet. So I don't think we'll be seeing any significant broad trends towards debt repayment as interest rates go up necessarily.
Okay. A question, John, for you on China. Is China's current struggles dealing with a real estate bust a concern for global growth, for the global growth outlook?
So I think China more broadly is a concern. It's the second largest economy in the world. It's been growing at a very rapid rate for years, and it is in many ways an engine of growth for the global economy. So when China starts to see its growth rate decelerate, as it must over time, to grow 7 or 8 or 9% per year is not really sustainable for any economy for long. So as that growth rate slows down, that's something that will affect the global growth environment. So it's something to be certainly mindful of. The steps that the Chinese government is taking today to try to manage through the situation with Evergrande and manage through just property investment in general, bank credit. There are many issues and challenges facing the Chinese economy today. And so for global investors, we need to be mindful of what's happening there and keep an eye on what's happening there. But I think so far, the way I would characterize it is I don't see anything from an economic standpoint from China that makes me overly concerned about the global economic environment and the investing opportunity set. The Chinese economy continues to be a dynamic economy with exceptional growth, even if the growth rate is slowing down and even as they try to manage through some of the challenges that they face.
Just one on climate change, John. How do you see climate change affecting your investable universe and the companies in your current portfolio?
So climate change is real, and it's affecting us in our day-to-day lives. It's affecting us in the way we think about managing portfolios, and it affects the way we think about the opportunity set and the companies that we look at. So, on one level, we're looking at companies and we're wondering which companies are well positioned for an environment where climate change is an issue and climate change policies are becoming more prevalent and more strenuous, I guess is the word. So it is something that we're thinking about as we look at companies, and we look at companies, energy companies, for example. We have some energy companies in the portfolio. One of the companies that we own is Total. And one of the things that we like about Total is that they have made a very clear, strategic statement about how they see their business evolving and where they are investing capital in a world where that they recognize is not going to be an oil-dependent world forever. So renewables, LNG, there's a variety of ways that they're allocating capital as they seek to manage that business. So maybe that's one way to answer your question. As we look at businesses, we're wondering, how are they positioning themselves? How are they managing? How are they recognizing and acknowledging this changing environment? And I guess the last thing we want to see is companies that are somehow pretending that it doesn't exist and it's not going to affect them and they don't have to worry about it. Because it is happening and it is affecting all of us. And we have to think about that when we invest in businesses for this strategy.
And maybe just one last final question, John, and this is from previous trips to Australia that you've made as part of our Epoch roadshows is, on those previous trips, you've said many times that with respect to company dividends, rather than finding companies that currently pay a high dividend, the key or the true skill is finding companies that can actually grow their dividend. Now that we're coming out the other side of COVID, how excited are you about the opportunity set coming through your screen? And what does that mean? And what does that mean for your portfolio in the future?
Yeah, and I think, as I've said, the opportunity set continues to be full and rich. As many of you probably know, we use a proprietary screening tool. Every week we run the screen, and every week It identifies companies that have the basic characteristics that we're looking for: dividend growth, cash flow growth, et cetera. And we continue to see an opportunity set that is as big as it's ever been. Week to week, it might ebb and flow a little bit, but the general trend is we still see lots of companies that pass the screen, that have the characteristics we're looking for. And as I've said, we think this is an environment where, as the global economies return to growth and recover from the global recession of 2020 caused by the pandemic, this is an environment where businesses will see better earnings, better cash flows, and be in a position to pay dividends, to grow dividends, and to use excess cash flow to buy back stock and or pay down debt. So it looks like an environment that is favorable for us in that regard.
Fantastic. Well, John, we're coming up close to the hour. I know it's nearly 7 p.m. in New York. So I just wanted to say, on behalf of GSFM, thank you very much for taking the time to present to our clients this morning. We look forward to the time when you can return to Australia and meet with our clients once again in person, and hopefully that's not too far away. So thank you again.
Well, you're very welcome. It's a pleasure to be here, Steve, and I do look forward to coming and seeing you in person. So fingers crossed that maybe is a 2022 event.
Let's hope so. Thanks again, John. Ladies and gentlemen, thank you for your time today. And again, on behalf of GSFM and Epoch, thank you very much for coming on the call today, but also for your ongoing support of the fund. It really is much appreciated. I suppose just a few closing comments. I would say that this income strategy was designed for retiree investors, as it's simple, straightforward, and based on sound principles. And really, Epoch's goal is to be the global manager in your client portfolios that you can rely on for consistent and growing income. As mentioned in my introduction, GSFM, we launched the Epoch funds in 2008, as we thought a global dividend strategy would be a great complement to Australian equity dividend strategies. Well, some 13 years on, and with rates as low as they are today, this dividend strategy has become more relevant today than we ever expected. And you could argue, based on the outlook, it will remain that way, remain very relevant for many years to come. I'd encourage you all to visit Epoch's website. It's a fantastic website. There's some terrific market insights, white papers, podcasts, etc. Their website is eipny.com, so epichinvestmentpartners.com. Please visit that. Look, hopefully we're not too far away from seeing you all in each of your capital cities as the country opens up. But once again, on behalf of everyone at GSFM, thank you very much for joining the call. And we look forward to seeing you again soon. Thank you.
Thanks. Take care, everybody.